Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm here with a couple of my associates. To my immediate left is Nick DeVito, also a CFP, and all the way to the left is Ryan Keefe, also a CFP. And Happy New Year to everyone. And what we were doing, someone came up with the idea of kind of going over some New Year's resolution topics. I hate the concept of a New Year's resolution. So we'll just look at it as sort of what you should consider doing to start the year off on the right foot and forging ahead from there. You guys...
It's general principles that you can apply at any time in your life, pretty
right.
much.
But, for those people who like to try to think that they're going to do something at the beginning of the year...
Well, then this isn't a video for you as well.
Hopefully you take it and continue, like the gym membership, which is good for, maybe a few weeks.
Gyms are very crowded the first couple weeks.
That's right. Exactly. So, basically what we're going to do, and we kind of tried to figure out what's the best way of organizing this thing. And what we'll do is basically look at it as it's the 6 areas of financial planning. It goes back to the fundamentals again. But beforehand, really, the two things that really need to be done is to really identify what your goals are. What are your financial goals? Yeah. Right. As well as getting organized.
Yeah, because it's very hard to move towards something when you don't know what you're moving towards. So
Correct.
The first step is setting those goals, and then once you kind of get your arms around everything, you can really go from there and say, okay, how do I attack these goals? What are some actionable items that I can take to work towards them?
Right. And getting organized is also really important. It's so easy to be overwhelmed when you're not organized, but once you get organized, it's really not that hard to maintain. Mm-hmm. And you just don't want to be overwhelmed by the finance stuff because it's not difficult. It can be tedious and it can be daunting if you're not familiar with it. But education is, we believe, big. We're big on education, and when you know this stuff, it helps. Mm-hmm. To be able to forge ahead.
Yeah. And we see a lot of people come in for their first meeting and we ask them to bring their stack of stuff. And they come in and they got, a manila folder with pages falling out and giant insurance policies. If you just take a minute to get all of that down onto, a balance sheet or something that's more organized and easier on the eyes,
right.
It'd be a lot less intimidating to deal with.
Absolutely. So let's start with the first thing is the 6 areas of financial planning are cash management, tax planning, insurance planning, investment planning, retirement planning, and estate planning. Kind of follows a natural progression. Cash management is looking at today, estate planning is looking at the very end, and it does follow sort of a natural progression, but it's probably the most organized way. Hey, we're talking about getting organized. Let's just organize how we're going to present this in the form of the 6 areas of financial planning. This is going to end up being 2 episodes so that we can kind of go into each of the details a little bit more. So let's kick off with the cash management as the first one.
So I'd say one of the first things you can really look to do is establish that emergency fund. 3 to 6 months worth of living expenses. That way, if you were to lose your job, disability, any kind of extraneous event like that, or there's a big repair that needs to be done on the house, or any kind of big cash need event, you're set for that. So once you kind of have that, it provides you that level of comfortability that you can then move on to the next steps and bigger goals.
Right, and there's a lot of ways, the whole emergency funding of 3 to 6 months of expenses. There's a lot of 3 to 6 months of income. A lot of it also comes down to how adequately insured you are. Mm-hmm. So, for instance, if you're concerned about losing your job or disability, obviously disability is an issue, but if you have really, really good coverage, then the impact to your financial goals are less of an emergency. Mm-hmm. If you have a job that is very much unionized and very protected, or you've got tenure at a location, you're getting laid off may be less likely. Yeah. And therefore you may not need as much of the emergency fund. But there are forms of emergency funds. And one of the things that we often recommend is for those people who own their home and have equity in their home, you could actually utilize your home equity line of credit as an emergency fund as long as the first two words out of your mouth that are closing aren't woohoo, but the whole idea is to be able to have access to money in the event of an emergency.
Because oftentimes we'll see people that are concerned about their emergency fund, and yet they have debt lurking out there.
I know.
And it could be high interest debt. It could be credit card debt. It could be a car payment or a car loan with high debt on it. And we look at it, and they're so focused on getting that emergency fund. And while that is great, if they have that HELOC available to them, sometimes you can kind of play a little bit of a shell game there, shift it around and maximize efficiency in that manner, and use that emergency fund or use the HELOC as a form of emergency fund. When you have debt that could be costing you 10 to 20 to 30%, it doesn't necessarily make the most sense in the world to be prioritizing that emergency fund.
And we've seen this many times before. While we commend the folks for having money set aside, they have the emergency fund and the debt there as well.
Yep.
And the emergency fund is earning diddly squat in savings, whereas the debt is costing. So if you can create a mechanism, like we used the home equity line of credit as an example, but if you create a mechanism that allows for the emergency fund, but then you can pay off this debt, then you're saving on $10,000. You could easily be saving $1,500, $2,000 a year. That's $150 a month. Just in wasted interest.
Yeah, and going off of that, right now interest rates are high. So another thing to consider when you're doing your emergency savings is making sure you're getting a good rate on that.
Right.
Because oftentimes you'll see the big banks out there, if you have a savings account with them, you might get 0.1%, 0.2%. Right now interest rates are elevated and you can get around 4% risk-free. So make sure that if you have that emergency savings, you're taking advantage of the high interest rates and finding the best rate. I'm not saying you have to always go for the highest one. And because we do have people that do that, where they're always chasing the highest one and they're moving bank accounts to make sure that 4.10 versus 4.05. I'm not saying do that, but take advantage of the interest rates when they're high and maximize interest rate efficiency any way you can.
Correct.
Agreed. And there's, I'm a big fan of always having your emergency savings be automated. So, when you get that paycheck that comes in every 2 weeks or twice a month, you have whatever amount set aside. It just goes to a separate bank account automatically. You don't have to think about it. And that's why I really like those, savings accounts that earn the higher interest, because generally they're not at, the more bigger banks that people just do their regular checking with. So you just have it go to this account. You never really see it. And if you don't see it, you don't really think about it. And then it kind of accumulates, but it's always there if you ever need it.
That's a great example of pay yourself first.
Oh, yeah.
And, that's the idea of 401ks automatically being withheld from your paycheck, as well as having automatic monthly withholdings, because you're not seeing it first, because human nature is you're going to spend what you have. Okay, and that's just human nature. You're making $80,000 a year. You're getting used to a particular lifestyle, and you're spending. Suddenly, you get it raised to $90,000. It's remarkable how soon you're living on the same amount of money, and then $100,000. Next thing you know, that's what happened. Yet, when you lose, or your income is reduced, it's painful at first, but it's funny. All of a sudden, it seems to magically work again. So, pay yourself first is a great attitude to take. Now, the other thing that we spoke about at length, and we talked to all our clients about this, is not necessarily budgeting per se. A lot of people don't like the term budget.
Yeah. It's a bad word to some people.
Right. But, and I get it, but understanding your expenses is an extraordinarily important thing to do, because where's my money going is important. And you guys are familiar with, there's a variety of different apps out there, okay, that you can do it with, whether it's an app on your phone. I'm not a phone guy. I'm more of doing it on a computer because the screen's bigger and the keyboard's bigger, and my fingers aren't quite as fat on the keyboard as they are on my stinking phone. But you guys use apps, and these apps, talk about it.
There's a couple different ways of doing it. There's the app route that you're talking about. There's the old school way of going through credit card statements, going through bank statements. So really finding whatever works for you. But there are apps out there that can take all your credit cards, your bank accounts, integrate them all into one platform, and show you all your expenses. Now it can go out there and categorize them for you. A lot of them require a little bit of training. So the example we use is the gas station. If you ran in and grabbed some food versus you got some gas, usually it's pretty easy to tell, but you have to train the software sometimes. So I think, to Mike's point, when we say budgeting and understanding your cost of living, you don't need to know You don't need to say, oh my gosh, I was $10 over my grocery budget this year or this month. Oh my God. No. Just understand where you're spending your money. And if you can notice trends, and I think that's what those apps really help you do is notice trends. Are you spending a lot eating out? How much are you spending on Amazon? I mean, we've had the sticker shock effect when we have people come in and visit with us and see us and they say, oh my gosh, I spent how much eating out last month? I didn't feel it because, it was a little bit here, a little bit there, and it all adds up. And it's really hard to move towards your goals and kind of allocate your savings appropriately when you don't know where your money is going. So I think starting with understanding your spending and understanding your cost of living is a great first step.
Absolutely, and it's remarkable how many people don't realize. And I use the hard way, because when I was doing it back in the 90s and also even after that, I did literally a spreadsheet and I entered it and I had every stinking column known to mankind. But the final column was the miscellaneous column, which is the size of my mortgage. That is where you come to the recognition of, holy cow, look at how much money I'm spending, whether it's Starbucks, every day, or going out to dinner 2 or 3 times a week, or picking up takeout. You'd be surprised how much this impacts your cost of living, and it's not as if we're recommending, because everything is a prioritization to you. Okay, what's more important to you? Eating out 3 days a week or eating out 1 day a week and trimming a year off of the amount of work that you have to make? I can retire 1 year earlier. It's not our job to prioritize, but you got to understand your goals. And if it's important to do certain things, well, then that's fine.
And I think what having goals allows you to do is if you can track those goals and really quantify it and even chart it. I know oftentimes we'll have people come in with debt and we'll say, look, put all your debt into a spreadsheet, track it every month, every quarter, whatever works for you. And then seeing that number go down over time and seeing that chart go down over time is very motivating and helps keep people on track, and it helps them make those decisions of, you know what, I can either pay down my debt or eat out. I really like seeing that number go down.
Absolutely.
I'm going to throw that money towards my debt. And on the other side of that, too, is savings goals. You're saving for retirement. You're saving for a new house. You're saving for whatever that may be. Tracking it and seeing that number go up over time is also very motivating. So I think setting the goals is important. Understanding your cost of living is very important. But also tracking in some way. You don't have to be super detailed about it, but I do find that it can be motivating to see that progress.
And I think one of the things that these apps really, really do a great job at is we live in the world of subscriptions, where you need to watch this football game, so you got to sign up for this specific streaming service, and then you never watch that streaming service again. All of a sudden, you got 5 of these, and they're just building up, and they're going to cost you, $50, $100 a month, and you're not even using them. So these services really help identify, hey, this is what you're spending every month, whether you know it or not. And you can, identify, okay, I can cancel these, and then.
Oh yeah, you know what? I can only imagine my Comcast and Verizon bill. It's probably a worthwhile exercise to review them periodically as well. Right. I mean, it's Comcast and Verizon around here. Other areas of the country, I'm not really sure whether they have but let me tell you something. All of a sudden, it's getting to be over $300 a month. I got to take a look at all of these things that all the different apps, whether it be Netflix, Apple, and all the different things that I have on there. For all I know, I'm getting nickel and dime, $2 here, $5 here, $10 there. That's another way of taking a look at it, and that's a good point that you brought up. And so once you kind of have your goals in hand, where your money is being spent, and then taking a look and prioritizing, then it becomes a question of saving versus spending.
Oh, yeah.
And it's remarkable, the younger you are, how much of a difference just a couple $100 a month can make over the long haul. It is remarkable that, and I ran $5,000 a year, that if you put $5,000 a year, which is $400 a month, into some type of savings program, over the span of 30 to 35 years, you will accumulate over $1 million. And boy, is that going to make a difference, between, again, a dinner a week is $1 million in 35 years.
Yep.
Kind of makes things...
Puts things into perspective for you.
Correct.
Actually makes those decisions a little easier for you.
That's correct. That's correct. So the next area is tax planning, which we'll do is we'll take a short break right now. We'll pick it up with the tax planning as a second area of financial planning that you should take into consideration. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and what we're talking about is Happy New Year and the quote-unquote New Year's resolutions. But what we're really doing is talking about, some habits that you can really get into at the beginning of the year. And what we emphasized in the first segment, started off with, is what are your goals and objectives as far as your financial goals, and then also getting yourself organized. Then we moved into cash management, which is taking a look at what you got going on today, budgeting, cost of living, et cetera, and understand where your money is going. So the next area we're going to talk about is tax planning. I always say tax planning is not something you do on April 15th. Tax planning is something you do throughout your life, because inevitably during the course of lifetime, things change, okay? But what we're referencing here is more towards planning for that particular year. All right, now mind you, this falls under goals, and tax planning, we've been really beating this drum a lot, that the tax rates are at historical lows, the lowest they've ever been in our lifetime, and probably the lowest they ever will be in all of our lifetimes, and it's taken advantage of it. But the other thing that I wanted to talk about here is making sure you got enough money going into the system. The government withholds money from your paycheck every week, right? Because they don't want you to be paying it all at the end. And they have guidelines and rules that say if you don't give us enough, they're going to penalize you on it.
And I mean, it's not, I wouldn't say it's every client we come in and meet with, but there's enough clients that come in that they have a tax penalty at the end of the year. And we always tell them, you're going to have to pay taxes. That's unavoidable if you're making money. You're going to have taxes. But paying a penalty, that's just foolish. You don't need to be doing that. And to the extent that you can avoid that, you want to avoid that. Right. Because, even if it's a few $100s, it's a few $100s you wasted for no reason. That is very easily avoidable. And I think what we're talking about when we're talking about tax planning here is we're not saying you need to be a tax expert. Mm-hmm. By any means, that's not what we're saying. But I think having a solid foundation and a basic understanding of how the tax system works, the different taxation entities that are out there, I think having that fundamental knowledge and even just understanding that we have a graduated tax system here. I know the one example I point to all the time is I have a friend who's a nurse, and she does traveling nursing, and there were nurses in her unit that said, I don't want to take this contract. I'm going to make too much money. It's bumping me into the next tax bracket. And they would not take a contract because they said it was going to cost them too much money in taxes. And just a basic understanding of the fact that it's a graduated system, meaning if you're at in the 22% bracket, you break into the 24, it's not all of your income that's taxed at 24. It's just that portion that goes over. So I think a fundamental understanding of the tax system is very important. It helps avoid those mistakes and misconceptions.
Absolutely.
And one thing that I always encourage our clients to do every year is, after the first, maybe even second paycheck you get, send us over a pay stub, and we'll take a look at the withholdings. Make sure, one thing, you're not going to be surprised in next April when you have, a couple $100s, even a couple $1,000s owed in federal taxes. Plus, you started off in January, February of the year. Dividing whatever dollar amount you need to increase your tax withholdings over 26 or 24 paychecks hurts a lot less than having to do it over 10 paychecks at the end of the year.
Exactly. Nobody loves that surprise at the end of the year. When you owe $2,500, and to Ryan's point, you have the ability to, that's $100 per pay period. To avoid a $2,500, nobody likes to stroke a check for $2,500 at the end of the year. Mm-hmm. And not to mention, to your point, chances are there's also penalties. So it's just a lot easier to absorb. And if you're self-employed, there are tricky ways of doing it. Mm-hmm. But, one of the things is that you should take a look at your tax return from last year. If you owe $2,500, then just very simply modify your W-4 and just withhold extra money. Okay? Or in the event that you have other things going on where you've got other businesses and things like that, you really need to be working or ought to be working with your accountant so that you're developing a plan for putting the money away so that you're not surprised at the end of the year or next year and penalties, et cetera, et cetera. It's just understanding it and making sure that you don't get whacked.
And I think what people don't necessarily realize is the payroll company that you use, they only know what you make. So they're basing off how much they're withholding based on your salary and your salary alone. So if you're married, you have other forms of income, they don't know about that. Unless you have an accountant that's doing all of that for you, the payroll company does not know that. So that's, if you're a single individual and all your income is W-2 from one place, you're probably going to be fine. If you're married or you have other sources of income, that's when you may run into issues where you're not withholding enough because they don't know your other sources of income.
And one very important thing is, the last time I really remember there being a big issue with a lot of people and their tax withholdings through work was when the tax laws changed.
2018.
And guess what? The tax laws are set to sunset at the end of 2025, which could present a problem for a lot of people in 2026 if they don't review their tax withholding.
Right, and I'll tell you what, we were doing some training with some of the new folks, and we were taking a look at the tax increase to go from the existing to the new taxes, new taxes being the old taxes. Every single case was like 15 to 20% increase in their actual tax.
Yeah.
Go from like 6,000 to 8,000, that's like a 30% increase.
Oh, yeah.
So people are going to need to be aware of that as well, because we run the risk of that having an impact on cash flow for people. But again, it's just understanding what your expectations are, so that you're not expectations of taxes, that you get the money into the system, so that you don't have surprises and you're not paying penalties. And things you can also take a look at with your investments is you can see whether you have gains or losses and whether it'd be advantageous to take gains or to take losses.
Yeah.
I mean, there's just some interesting things that you can do with that as well.
And I think that's also something that people forget. I mean, there's been a few clients that have come in and they have either investment accounts, it may be from employer stock that they've accumulated, and they've been paying out dividends. I think understanding the tax documents that you have is also very important. Understanding what you're going to get your W-2 from your employer, but also know that if you have investment accounts, look out for that 1099 that's going to be coming in the mail or to your email, because you have to report that. The onus is on you to report your income. The government's not going to tell you in a nice way that you didn't report something.
Well, it's a good point, because we've come across this plenty of times where person doesn't realize that they got a 1099, they don't report it, and next thing you know, a year later, they're getting that friendly letter from the IRS. And we see that a lot.
Yeah.
So, this time of the year, first of all, we always recommend to all of our clients that they do not have tax documents emailed to them, because with your investment accounts, if you're getting your email, I don't know about you guys, my email, I don't want to be getting email. I get so many emails. It's too easily lost and just not opened or whatever the case may be. I always encourage to have the tax documents mailed. So the rule is that 1099s, et cetera, W-2s need to be produced by January 31st, with the exception of investment account 1099s. I'll be clear on that. If it's an IRA distribution or a Roth IRA, those will be there by January 31st. But investment account statements, the 1099-B, that shows dividends, capital gains, and interest, and things along that nature, they're actually extended out to the end of February. In most cases, they're distributed the second or the third week of February, so a lot of times you have to wait for that. And then other documents such as K-1s, and there are people who have K-1 investments with K-1s, they don't get them until April, and they've already filed their taxes.
And
That's
I
a
think,
pain.
and I think what can really help this too, kind of going back to something we talked about earlier, is getting organized. Like for me personally, I have a spreadsheet where I have all the tax documents I'm expecting for the year. So I know going through my accounts, okay, I'm going to get a 1099 for this account, I'm going to have my W-2, whatever that may be. I think getting organized, going through, and then this can also circle back to what we talked about earlier, creating a balance sheet, looking at all of your accounts in one place. Then you can identify, okay, I'm going to get tax documents for these accounts, put them in that list. That way, tax time, you don't have to worry about thinking it. There might be other things on your brain at that time. You have that document ready. You know what to expect. You know what to look out for.
Yeah, it's a good idea. It's a good idea. So the other thing that we'll talk about until we move into the next episode is insurance planning. So, a lot of your insurances that you carry are through work, and they have typically open enrollment is October, November, and that's where you're picking out your disability insurance, your medical insurance, and all that. However, what's not covered there, or can be covered there, is life insurance. Okay. We've had a full episode just on the life insurance coverage. As a general rule, life insurance coverage, if you're above average good health, is actually cheaper to get it outside of work. If you're below average health, then, or overweight or what have you, then you're actually better served getting it through work. But what's more important than that is identifying the appropriate insurance need. Okay, there are reasons why some people don't need life insurance. Okay, because what's life insurance? Life insurance is to protect your paycheck. And if you have no dependents, you're single, you don't really need life insurance.
Right.
Okay,
Or if you may have dependents, but you've accumulated enough assets outside of that to where it can cover them and adequately
Right.
pay off a mortgage, cover your income, then you might not need it. So I think
Right.
a great first step for any kind of insurance is identifying your needs, to your point.
And by the way, you may need more.
Yeah.
Okay. But then the other ones that are a little bit more obscure is your property and casualty, which is your homeowner's insurance, your automobile insurance, and it is encouraged even by experts within the industry as well as outside the industry that you really ought to be reviewing your coverages every 3 years. Okay. And that's both homeowners and automobile. The thing about it is that, a lot of companies like to advertise the savings that you get. Well, a lot of times that savings is not comparing apples to apples. Is they're saying, well, we can give you savings by reducing your coverage in all these different areas. All we can ever tell you is never go underinsured, okay? Insurance is there for a reason. It's to protect you for the what-if scenarios. And the more likely something's going to happen, the more you have to pay, like medical insurance. You're paying $600-800 a month. Why? Because you're more likely to go to a doctor than for me to die in a car accident or something like that, right? So it's just important to understand your coverages and work with your property and casualty, your life insurance, your automobile insurance, your homeowners, just to talk to them about, use them as a consultant as to what's the appropriate coverage that you should have, not what's the cheapest.
Yeah, and I think going back to the employer coverages, I think understanding them is very important because, yes, people might know they have some life insurance. Yes, they might know they have some disability insurance, but they may also have the ability to buy up in both those areas. To Mike's point, life insurance could be cheaper on the outside. That's something you kind of have to evaluate individually. But for the disability specifically, a lot of times the employer will provide a level of coverage, maybe short-term disability, up to 60% of your income. And then you have the ability to buy up additional coverage. So maybe you can buy up to 70% or 75, whatever that number may be. So I think understanding what's available to you is also very important, and taking advantage of that if it makes sense is also key.
Yep.
And a big thing that I always stress with clients is when you have your insurances, make sure you're reviewing your beneficiaries every so often. You'd be surprised how many people come in and, oh no, my ex-spouse of 20 years is still the beneficiary on my life insurance policy. Like, I set up these trusts for my kids, but the trusts aren't the beneficiaries of these policies. So you want to make sure the money's going where you intend it to go, and you'd be surprised how many times that goes overlooked. Another big thing with beneficiaries is understanding, per stirpes versus per capita. Do you want the life insurance money if you got 3 kids? Do you want it to stay within those 3 kids? So one of them predeceases you and then you pass. Do you want that to then go 50-50 to the other 2, or do you want it to go to that deceased child's descendants? And that can be a very expensive and very costly mistake, which should be reviewed.
All right, thank you for jumping ahead, Ryan. We'll be repeating that when it comes to the estate planning component. So thank you for joining us. What we're going to do is we're going to have a second episode come the following week. We're going to pick up from where we left off today. So thank you for joining, and I hope you have a wonderful day.